Yesterday's big news, we saw Fonterra revise down its forecast payout for this season. Now we've seen them lower the milk price component by 15 cents per kg to $6.35. Now this brings the payout level back to where it was last December before we saw Fonterra revise it up initially. Now Fonterra note that some easing in global dairy prices, the combination of the higher New Zealand dollar is largely responsible for the lower payout forecast. Now we have seen global dairy prices ease somewhat over recent months, but this is from very high levels and they are correcting largely as we see a recovery in supply. Strong production growth from New Zealand is a large contributing factor to this. Indeed, if we think about the extent of volume growth we've seen from New Zealand this season, it's actually fairly encouraging to see how well dairy prices have actually held up in global terms. Now Fonterra are expecting further easing in global dairy prices going forward. We've seen an increase in competitors from our northern hemisphere, largely as we've seen a correction in feed prices as well as higher dairy prices encouraging a higher milk output. Now looking forward to next season, we do expect that the milk price will be even lower still. We're looking at $5.75 and this is largely on the back of the higher New Zealand dollar that we're expecting for this year. Fonterra's downward revision to the milk price payout weighed on the New Zealand dollar yesterday and we saw some declines through trading. We then saw some further declines overnight as markets took a fairly cautious tone. What was weighing in sentiment, particularly for the New Zealand and the Australian dollar, was the weaker Chinese trade data that we saw released over the weekend. Now the Chinese trade deficit blew out in February, largely on the back of a very disappointing bounce back in exports. Now over the past few months we have seen Chinese data disrupted by the Chinese New Year, which has fallen slightly earlier than usual in January instead of February. Now, market had been expecting quite a bounce back in exports over February, but we do expect that the softer increase is largely due to the Chinese New Year disruptions. Nonetheless, the weaker result does raise concerns that the slowdown in Europe is in turn having a larger impact on China than previously thought. But we do see some encouraging signs, in particular the strength of Chinese imports. These are up strongly in February and point to restocking, and it is a sign that Chinese manufacturers are becoming more confident in the future, and we expect to see that bounce back in March.